Hi everyone. Today we're with the market strategist of CGS-CIMB and the co-chair of Chartered Market Technician here in Singapore. So introducing Mr. Jake Chow. Hi Jake.
Hi JC. Hi.
All right. So today we're gonna be discussing about your experiences in the markets and tell us about your journey. So first, tell us about your background. How did you first start in the financial markets?
Well, I first started the financial market around 10 years ago. I joined CGS-CIMB as a broker. And of course, I was a broker for 6.5 years before I switched over to research.
Yeah.
And thereafter, I was in research, mainly focusing on technical analysis. And right now, I'm more on quantitative investment modeling.
So ever since you were mainly focused on technicals, not on the fundamental side.
Now that I'm doing quantitative modeling, I do pay attention to fundamentals. In fact, if you are in the market long enough, I think both are actually quite intertwined or interrelated. And therefore, the models have combination, usually they have a combination of fundamentals and technicals. It depends how you want to play around with it, depends on how you want to engineer what you want to achieve in your model.
Okay. So what sort of fundamental metrics do you try to combine with technical parameters?
Well, actually, most of the technical indicators or the fundamental inputs are actually quite generic, the most basic ones. In fact, the more simple it is, the better it is.
Okay.
You don't have to be very fanciful to achieve your objective. Sometimes the simple it is, the better it is.
Okay.
Yeah, this is after running tons of back tests. Yeah, correct. The results are very clear. Try to keep it simple. In fact, I do agree with a lot of practitioners in the quant field. They do try not to get too carried away by putting in a lot of things into the recipe. Yeah.
Okay, so what's a sample of these simple fundamental metrics?
Well, some of the key things that I always pay attention would be valuations, things like your price to book, P ratios, price to sales, price to cash flows. These are the things that, well, everyone is also paying attention to, but how you derive your model, that very much depends on how you engineer the whole selection process.
Nice. Then you combine those with technical parameters.
As well, correct. Because academic literature has also proven that combining fundamentals and technicals are very, very beneficial to the portfolio and investment results. And also at the same time, we cannot deny the fact that valuations and momentum is negative correlated. If you put them together in a very efficient way, it works. It's been proven to work and I've been using it myself.
So even though they are negatively correlated...
In fact, correct. That actually diversify your risk and improve your performance.
Oh, so sometimes you're exposed in momentum stocks, sometimes you're exposed in value plays.
Yes, correct. At the end of the day, what we're trying to do is we try to blend the two factors together. We are trying to look for undervalued stocks that seems to be on the brim of recovering.
Oh, I like that.
Yeah.
That's good. Okay. So when you were starting as a broker, how did you transition to the research field?
I was a broker for 6.5 years. And after that, after going through the life as a broker, I realized that good trading or good investment starts with good research. And therefore, I took the opportunity because right after I passed my CMT, I got my chartership in 2015. There was an opportunity that I can switch to research and my boss gave me that offer. I decided to give it a try.
So which side of the business do you like most, the broking side or the analysis part?
Well, actually, I do miss the broking side, but I would have to admit that I enjoy doing research more than being a broker.
Oh, okay. How do you impact the clients? How do you deliver value to them?
Well, as much as I can, I have to be very objective in doing my research and educating clients how to manage the risk, because at the end of the day, whether you're successful or not in trading or investing is very much about managing your risk. If you can't manage your risk, then it's very hard for us to grow the portfolio. So with that bearing in mind, that forms the basis and the foundation of any kind of research, be it fundamental or technical research, or for that matter, quantitative as well. So yeah, even in my quantitative model, I always focus on risk. Yeah.
So on a typical portfolio, how many stocks or assets would it be composed of?
It very much depends on what is your objective. If you are very comfortable with managing many stocks in your portfolio, I would say having many stocks actually diversify your portfolio. But of course, it kind of like dilute your performance along the way as well. Empirical research has shown that typically a 25 to 50 names investment portfolio is good enough to diversify or bring down your risk by quite a fair bit. And of course, but then again, not many people can run those portfolios with 25, 50 names. But I would say at least a 10-name portfolio is...
For the typical retail trader.
Correct. For the retail investor, 10 names is, I would say, the basic starting point.
Okay. So 25 to 50 goes for the institutional levels?
Not exactly, but 25 to 50 is just the sweet spot.
I see.
Correct.
I see. Okay. So... tell us about the Chartered Market Technician program. How did you first discover it?
I actually discovered the CMT program in 2011. So me, then again, having the research genetics in me, I spent 1 year trying to research because there are two programs in the world. We have a CMT program and an IFT program. Correct. So I spent a whole year researching on them, talking to people which program is better or not. But of course, at the end of the day, I decided to go with the CMT program. Yeah.
When did you finish the whole examination?
I finished the program in 2015, and I got my chartership within the same year.
Okay.
Yeah.
So what made you decide to take the CMT?
The CMT program is a bit more rigorous based on what I found out, and of course at the same time it restricts professionals to having the chartership. So that gave me a better sense of confidence.
Okay.
Yeah.
So what would you tell about the audience if they wanna check out the CMT program? What would they get as a whole?
Yeah, in fact, the CMT program gave me a very solid foundation in quantitative analysis. You'd be surprised that there are a lot of quantitative methods and analysis being taught in the program. And that leads me to discovering more in-depth quantitative research methods and modeling aspects as well. So I would say it's not unusual for a CMT guy to be quantitatively driven or involved in the quant side of investment or trading. And I just choose to like quantitative better because it's more systematic. Traditional technical analysis, it's still numerically driven, but sometimes subject to interpretation. That's the thing I don't like, because the reason why I like to be systematic is because by nature I'm not systematic. So in order to improve my investment and trading performance, I need to make sure that I'm systematic.
That's nice. So I share the same philosophy. Actually, I'm at the CMT level 2 right now. So
congratulations.
Yeah, but I haven't finished yet, so I need to.
I will be a sponsor.
Yeah, I need to. Yeah, hopefully in the future. Yeah. So what I like about it, when I was starting, I started the regular technical analysis, patterns, trends. But then when you look deeper, you are very correct that it all boils down to the numbers.
Yes, right.
Yeah. And the next level of the basic TA is the quantitative side.
Yes, right.
And what I like about the CMT, the first few modules were the basic technicals, like even to the point of point and figure charting.
Yeah, that's very old school.
Yeah, that's true. That was the painful part. But what I like in the newer modules and the exams, they were tackling higher level. It was evolving, basically.
It is evolving, yeah. Correct. The syllabus that we are looking at is much different from 3 to 5 years ago.
So I think for those who are planning to go into the industry and to really develop their edge, the CMT program will definitely help you in terms of your own trading, research, and your career.
Definitely, yes.
Okay. So what has changed after you've gotten your CMT program compared to your previous insights? What's the main difference right now when you put up analysis?
In fact, I've been, after I got my chartership, I was involved in a lot of modeling recently. And of course, that makes me want to dive deeper into a lot of empirical research. So I spend a lot of time reading other people's research and trying to fine tune what I've learned from them. Yeah. So it's just tons and tons of reading and research.
Nice. So how do you backtest these systems? Do you have your proprietary backtesting system here?
Currently, we are using Bloomberg to backtest.
Oh, yeah. Okay,
Yeah.
That's nice.
Correct.
Let's go back to your past. Like, in your experience so far, what was the biggest mistake that you've made? Like a trading call, perhaps? What was the most?
Well, I first started trading when I was 21. I'm 42 this year, or am I 42 or 43? I can't. I lose track. Yeah, that's almost 20 years of being in the markets. I first started trading multiple stocks at one go. I was very, very active, trading in and out, in and out. And one of the names that I was trading last time was Creative Technologies, which is languishing somewhere near the bottom right now. Correct. So that taught me one lesson about trading is don't overestimate your abilities. Always be open to learn about new techniques, new knowledge, new ways of engaging the markets. By knowing technical analysis is not good enough. Knowing fundamental analysis alone is not good enough. You need to be very, very in tune with the markets. And of course, by saying that, you need really to spend a lot of time to educate yourself and to be very open to all kinds of scenarios playing out. Never be too firm on a particular kind of belief.
Yeah, fixed mindset.
Yes, correct. You have to be very open. Whether you're a trader or investor, having an open mindset is very crucial.
Being able to change your opinion depending on the factors.
Correct. In fact, a lot of great traders in the world, a lot of great hedge fund managers in the world have been proven that by having an open mindset is very crucial to whether are you able to survive 3 or 5 years down the road.
That's true. So what happened in your trade back then? You held on it until it...
Well, I lost a lot of money holding my opinions. Yes, correct. And of course, I paid a price for that.
So that's where you
That was way
learned.
before, yes, correct. That was way before I discovered technical analysis.
You didn't know TA back then.
No, I didn't. But I was very keen, very interested, but I learned a bit, but I thought I knew everything.
Yeah. Okay.
I was young then.
Yeah. So going on the positive side, what was your most memorable market call?
The most recent one would be the recent run-up in the financial and the technology sector in the States. Actually, what we do as a researcher, we always try to find out where the capital is flowing to. During that sector rotation, we actually find that the financial sector, for example, in Singapore, the property sector has been bottomed out in 2017, and that was in 2017. I think it's around 2017, correct. Around 2017, the financial sector starts picking up and the technology sector follows. And that was one of the better calls that we make in our research reports and by helping clients to be on the right side of the market.
So you were mainly bullish the finance and technology?
At that point in time when the sector was picking up, correct. So it's basically our approach is from the top down. We look at the markets, we look at the sectors, and we look at the industries. And you really got to see where the capital is flowing.
Okay. So you follow money flow?
Yes, correct. That's very crucial.
Okay. So what do you think of what's happening in the equity markets right now? Like, markets are on the highs?
It is indeed. If you're just looking at the sector itself, if you're just looking at the top line itself, yes, indeed, the S&P and some of the market indices are showing you very, very bullish signs. True and not true. In fact, if you look deeper into the sectors, over the last 12 months, defensives are on the run. Actually, what the global asset managers and the financial managers are telling us is they're actually putting on the more defensive stance within the portfolio allocation. Therefore, the low volatility factor is very strong. Consumer staples are stronger than your consumer discretionary, and therefore the market is not exactly very bullish right now.
Oh, okay. So
despite the index being up all this while.
So it's like bullish but cautiously
bullish. That's correct.
Okay.
So looking at other market data, we can say that yes, indeed, the market is a bit overstretched until we have some breakthrough, whether through earnings or through some other uh, peace war, peace war, trade war, peace war. Well, if the trade war can stabilize, but I doubt so.
Yeah.
It's not going to be a straightforward and overnight thing. It will last for quite a while.
It seems like the peace in the trade war is temporary for now.
Yes, correct. It's likely just going to be for a week or two before Donald Trump starts his nonsense again.
That's the risk. So
Yeah.
when you speak of defensive names, what are the examples of these?
Like for example, recently consumer staples, names like Starbucks. Starbucks has been quite strong. Nike.
That's considered a defensive name. Starbucks.
Yes, correct. Nike, consumer discretionary, but it has a strong brand name.
Yeah.
Correct, and it's global. So therefore, yeah, it's one of the strongest name out there.
Okay.
Correct. And over the last 6 to 12 months, you see finance are going through a correction. Yeah.
Okay. The finance side.
Yes, correct.
Is it because of the disruption in the fintech industry?
Not just that, but more of an anticipation in a slower economic growth, and at the same time, interest rates cuts by the Fed.
Okay. Upcoming shift. All right. So how do you, when you combine valuations and technical analysis, how do you really say that a battered stock has like firmly bottomed?
Well, usually you're going to give it on the average 3 to 6 months time
to
bottom.
stabilize.
Yes, yeah. It usually takes around quite a fair bit of time. It don't quite bottom out within a couple of weeks. You've got to let it find the bottom, stabilize, at least form a double bottom. That usually takes about 5 to 6 months. And when it starts breaking out the previous highs, then there you have it.
No, that's the stability first.
Yes, correct. You need stability.
Then
don't be too eager to jump on a recovery or a bottom fishing path.
Just because a stock looks cheap.
Yes, correct.
Okay.
Yeah.
That's something to take note of. So most major bottoms, they don't go in a V shape often. Oftentimes it leads into basis first.
Yes, correct.
And that's where institutions can accumulate, right?
Yep, that's right.
So speaking, I do those kinds of trades a lot, but one thing that I take note of is the potential catalyst. If there's a reason why the stock will reverse. So do you put these catalysts as part of your model?
Currently, no, because I have other inputs to actually pick it up. I don't specifically use any inputs that I believe you are talking about, but by having momentum in your model,
it will detect it.
Yeah, correct. It will pick it up.
Oh.
Yeah. Most of the time, what it's trying to tell us is basically all the negativity has been priced in. And usually you got to give it a good at least 12 months of decline, if not even longer. Yeah, because the market participants need to price in all the negative news flow, all their disappointments, all their
the fear.
Yes, correct. All their hopelessness. Until you find a good solid bottom, then I would say, why not? Correct. Because when it starts picking up in terms of price momentum, I would say the last seller has already gone. Yeah.
That's true. And that's where people will chase again and get surprised.
And very likely things will start improving from then onwards.
Yeah, okay.
Yeah.
Do you find that most major bottoms will also come with fundamental reversals like earnings growth reversals or something?
Yeah, correct. It usually comes along with that. But of course, earnings growth are usually quite lagging.
Okay.
Correct. But of course, if let's say a company experienced negative earnings growth for the last, say, 6 to 8 quarters, and when it starts reversing, you will usually find that the pattern will persist going forward. Yeah, but you got to be patient and let it pass
until you see a positive quarter.
Yes, correct. Yeah. If you are a bit more conservative, let it be 2 quarters.
Just to have that consistency.
Yes, correct.
To take away one-offs.
Yeah.
Okay. So if I were to ask you your personal taste, do you prefer these value momentum plays or do you prefer going with the trend, riding all-time highs?
If you ask me, I'm more of a trend following guy. Yeah. But despite saying that, I still like to find names that are not too expensive
Yeah.
and trade them or invest in them. Correct. I wouldn't want to buy a stock that's trading 100 times PE.
Oh,
I would
okay.
try to avoid that. Not that I won't, but I'll try to avoid that.
Because especially on the institutional side, you have to give more justification.
Correct. Because bear in mind, those names are not the only names around. You have plenty of choices in the market.
Oh, yeah.
Yeah.
So right now, mainly you focus on USA and the Singapore local market?
Well, basically,
or global?
I follow global market.
Oh.
It depends on what I publish, what I research on.
Oh, so any country that you see opportunity into?
Yes, correct. But of course, US being the biggest or the largest market in the world, we have to follow it. Yeah, it's a trend setter.
Okay. So being a trend following guy, what was the biggest trend that you called and you just told clients, let's just hold on to this? Any experience like in your research days? Yeah.
Okay, if you ask me, among all the four major asset classes, equities is still the best performing asset class, despite all the volatility, despite all the bubbles. It still gives you the best returns. If you ask me, I'm still an equity guy. Well, of course, it depends whether you want to have more bonds, more equities. But I'm very bullish on equities.
Up to now?
Yeah, of course. I have a portfolio I've been holding for the last 15 years.
Yeah.
That's a Chinese portfolio.
Yeah.
I actually invested through a mutual fund.
Yeah.
I ride through the boom and bust.
Yeah. And it's still doing good now.
Yes, still doing good, correct. But you just have to have the guts and the kind of temperament to hold through it, because you know it's the best performing asset class.
Yeah.
Yeah.
So speaking of the performance, it's been like this bull market is like 8 or 9 years? Or?
It's 10 years.
10 years.
Correct. It's already 10 years.
What do you think of the period? Are we late on that bull cycle?
Well, based on all the market data that we can see, we are most likely to be at the late stage.
Yeah.
There's no argument about it. Of course, a lot of all this longevity of this bull market is due to the Fed. Well, the more the Fed intervenes, the more kind
artificial.
Yes, correct. The bull run, no matter it's artificial or not, well, it is still in the bull run. Yeah. And of course, from time to time, when the market needs to correct, we'll find that it corrects back to its 20 or 30 years moving average, quarterly moving average. Yes, correct.
20 to 30 years.
Yes, in fact, I've done a lot of research on that.
This is on taking into the 100-year period or something?
Yes, correct.
Okay.
Yeah, in fact, bubbles always pop. Are we in a bubble? I wouldn't say we're in a bubble. We would definitely have a lot of excess in the market. But when it does pop, it actually mean reverts back to its long-term average. And that itself is like a normalization of valuations.
Okay, Jake. So mainly you're still bullish with equities right now, right? But what do you think of the interest rates rising, warning signs, and the inverse yields? Or what do you think about all of these?
Just to put it in perspective, I'm long-term bullish on the equities market, but of course that's not to rule out that the markets will, from time to time, correct itself. Based on what you asked, I think the Fed will most likely make a few cuts to ease the tension right now to lift the global growth. But of course, going forward, I would say we are likely to face a slowdown. But that slowdown, it depends on how the market participants try to price the markets to a sweet spot, or what most guys would say the equilibrium. Okay. Yeah, and the equilibrium is more like the long-term moving average that will justify the right valuations. Right. S&P right now is roughly around 19-20 times PE.
19-20
Yeah,
times.
correct. And in fact, if you look at it, a 30% discount off 20 times PE, it's not difficult to say it's back to, let's say, 14 times PE. Yeah, but to a lot of investors out there, a 30% decline is end of the world.
Oh,
correct.
But based on bigger data, that's just normal, mean reversion.
Correct, it's just mean reversion, but it scares a lot of people.
Yeah. Okay. So if you look at the S&P, where is the 20-year moving average? Do you recall?
I do have those data on my Bloomberg. Yeah, correct. But on the average, it's about a good gauge would be a 2005 for the S&P and a 2000 for S&P for the 30-year long-term average.
Oh,
Correct.
okay.
Yeah, so of course nobody wants the market to correct that much, but then again, the market has the right to price the assets to its right valuations.
Yeah. How about commodities? What do you think of that? And they've been battered for a long time.
Well, commodities is a very segmented asset class.
Yeah.
If you ask me, I would say if we are just looking at the long-term returns of gold and silver, not very pretty.
Okay.
Not very pretty, but it does have a tendency, if you research the commodities market, it's actually on a long-term mild uptrend.
Yeah.
But the characteristics of commodities market is they tend to spike.
On
They have not just that. The trend is a multi-year spike and a multi-year decline.
Okay.
Yeah, and those declines are quite severe as well. Like for example, gold peaked in 2013, and ever since it started into a multi-year correction.
Nothing has happened. Yeah.
Correct. But if you look at the long-term data, gold is actually moving up. It's in the long-term uptrend.
Oh.
Correct. Just that the way it moves is very different from the equities market.
Okay.
Yeah, every asset class has got its own movement, its own characteristics. Yeah.
So, who has been one of your most influential mentors or books?
Well,
that
there are
you
plenty
had?
of them. There are plenty of them. Just to name one of them would be Jesse Livermore.
Oh.
The current ones would be Ray Dalio.
Oh yeah, right now.
Correct. AQR.
What's AQR?
AQR is applied quantitative research. Yeah, they are one of the guys that I follow quite a fair bit.
Okay.
Cliff Asness is the founder of AQR.
Oh.
Correct. I'm a big fan of him.
Nice. They're an independent research house?
No, they actually are a hedge fund and mutual fund manager.
Oh.
They are based in the States. They are very big.
Nice.
Yeah. And of course, some of the other guys that I follow would be Jim Simons. Jim Simons is the founder of Renaissance Technologies.
Oh,
Correct.
The low profile.
He's a mathematician. He's a genius mathematician. Yes, correct.
One of the strongest funds, but you can't go.
Yes, correct. You
get it.
can't buy into.
Yeah.
You can't invest in this fund. Correct.
I've heard about
Yeah.
it.
In fact, if you examine, they are very secretive. But if you examine, they are actually trend followers as well.
Oh.
They are. Yeah.
Do you see their trades in Google?
No. We couldn't. But based on the interviews that James Simons actually gave, it's very clear that he's a trend follower.
Yeah.
Yeah, but of course, how you derive all your quantitative signals and how you do your modeling, it's a secret.
Not so simple.
Yes, correct.
Okay.
Yeah.
Because it seems like a lot of the quant guys are being used now for high frequency trading.
It really depends.
Yeah,
It
really
depends
depends.
which field you want to go to.
Yeah.
I'm definitely not a high frequency guy.
Yeah.
But most market makers or liquidity providers, they have to be. They have to be high frequency, correct? And therefore, by virtue of being high frequency, you need to be very quantitative.
Okay.
Yeah.
So they try to quantify the micro moves and.
Yes, correct. And any kind of data or any sort of inputs they can get hold of. Yeah.
Okay. So one interesting thing is, since we're in the era of social networks, social media,
Yeah.
have you ever put that into consideration as part of your models or something, like sentiment in social media?
Yes, I do notice that the trend right now is about all these quant funds picking up all the social media sentiment inputs. Currently, I'm not using any of those. Yeah, correct. I don't rule out we will start using it. Yeah, but as of now, nope.
Okay.
Yeah.
But you've read research that there's like an edge?
Yes, correct. You can actually have an algorithm that goes around the social media or internet to scrub for words, keywords. Yeah, you can do that.
When people are too optimistic, then that's
correct.
warning sign.
Yeah.
Just like an indicator.
Yes, correct. But that's something we choose not to use right now.
Yeah. Okay. Since it's kind of new.
Correct. Yeah, because a lot of times rubbish in, rubbish out.
Yeah. Actually, there's also a lot of fake.
It could be, yes, correct.
Okay.
Yeah.
You were in the markets already back in 2008 and 2009. Could you tell us what was the experience like encountering a financial crisis?
When I first joined the firm, it was actually towards the end of the great financial crisis. The markets was about to pick up.
Okay.
And in fact, if you ask me, in my almost nearly 10-year career here, the period of 08, 09, I think is one of the best time to go long.
Oh,
Yeah, Correct. And of course, in between, you have a couple of fears, crisis, correction. But those are actually very good signals or good entry levels for people who miss out on the recovery phase. And of course, right now we are at the late stage. I would say it's better to play on the defense. But nonetheless, if let's say you choose not to sell everything and go away, I would say hedge your portfolio with index futures, options, anything that you perhaps can not sell good quality stocks in your portfolio. Because by dumping it away, it's very hard to buy them on the cheap the next time round. Because, well, not everyone can time the market that well.
So how do you, knowing that we're in the late stage of the bull run, like how would you control your risk, like in terms of portfolio allocation or hedging? What would be your advice?
Well, for my own investment portfolio, I use a multi-factor model. And of course, the model itself would give me allocation to very defensive names. In fact, it's one of the models that we use and one of the way that we select, rather I select stocks myself. And definitely I will pick the more defensive names if I have to have them in the portfolio. Yeah, because bearing in mind, investors' key objective is actually on total returns. Correct. It's not just short-term returns, but rather total returns. Because by holding good quality stocks, even in a declining market, you get paid for dividends. Correct. You get dividend income along the way. Yeah. So, but then again, we have to decide, because from time to time we have to decide whether to hold cash, bonds, equities, or commodities for that matter. So it's about allocation. You can still allocate money to equities, but if you don't want to sell, just hedge your position. Yeah. If you don't want to hedge, then perhaps you are in a sweet spot to sell everything and wait until you get a good entry signal to find a bottom of the market. Then that's great for you.
Okay.
Yeah.
Speaking of defensive names, how do you define these? Are they the fundamental big caps or stable in terms of volatility or dividend players?
Correct. Typically, defensive names are low volatility. They have very good balance sheet. Their profit margins are typically high, and of course, when you look at their ROE, are very good as well. Correct. So, taking into account of all this, we will definitely have names that are very, very stable. Names that give you very good returns over the time and very defensive, high dividends as well. So with that, we just focus on holding those stocks right now. And of course, if let's say the market were to go into decline, definitely you will face some drawdown. Yeah. In fact, when you see in the event, if let's say the S&P were to drop 20-30%, I'm going to be a big buyer. Correct. Because it's like the what we call the Great Singapore Sale. Is the time for you to step in to buy more of good quality stocks at cheap valuations and being discounted, heavily discounted. Yeah.
So right now, you don't have any. What percent of your portfolio is in fixed income or bonds or safer assets?
Actually, I don't have any fixed income.
So this is a pure equity.
Correct. My investment portfolio is pure equities. Correct. Because I understand myself. Well, like all investors, you have to know your character, your temperament. Are you able to deal with the volatility? Yeah. I happen to be the type that I love volatility. I love to have risks from the equities market over the long run, because actually that's the best performing or best returning asset class.
So you're riding the trend but balancing it out by...
Correct. I do maintain a core portfolio, which means it's a long only, passive in that sense. I don't try to do too much of rotation and meddling with the portfolio. That means I keep accumulating the portfolio. Because you want to build your portfolio to be bigger and bigger.
Well, what's a sample name, some sample stock under this portfolio? These names?
Correct. Like for example, I do geographical allocation. Correct. Like for example, my Singapore portfolio, my call would be the STI ETF. I use the ETF to express my exposure, and of course I tilt with different names that I like, or I wouldn't say I like, the names that I've identified that I want to be in my portfolio. So I added more of those names. Some of the names that I added recently, I wouldn't say recently, some of the names that I favor is ST Engineering that I added, I think last year. Correct. And some of the names that I have is, for example, the Singapore Exchange. Well, because of the yield play.
Oh.
Correct. It's a monopoly, so it pays good dividend. It's a monopoly. Correct.
Nice.
And yeah, correct. So I add names to make it like a satellite, so that I have a tilt.
Okay.
Yeah. And I have other portfolios in other parts of the world. Correct.
So in the US, what names are you mainly focused on? Like two names, three names?
Currently, I'm actually short the US market.
You're short right now?
Yes.
Oh.
Correct.
So you're long.
I'm expressing my views on the short side for the US market.
Okay,
Yeah.
okay. So what names are you looking at to short?
I'm not doing any specific names. I'm using the index futures to express my short.
Okay.
Yeah.
So right now your call is a short on the market despite the new high.
Correct, but that's for me.
For your personal view only.
Yes, correct. So I don't encourage everyone to follow me.
Yeah.
Yeah. I'm just expressing my view, my tactical view.
Yeah.
Yeah.
So how do you establish a short position? Like, do you short now, or do you have a short on resistance or a certain?
Yes,
move?
correct. I like to short around the resistance levels.
Yeah.
Yeah, but of course I would like to add more shorts when it starts breaking down.
Yeah.
Correct. So it's like trading. You take a small position, and if it's moving in your favor, you pyramid your position. You add more positions because it's moving in the right direction. And yeah, that's what I do.
So you say to the clients, you're short USD. That's your main call right now.
I haven't published anything, but this is my view.
Personal view.
Correct. Personal view, and like what I said, I'm taking a small position.
Small position first.
Correct. And if it does play out the way it does,
That's where you add.
I will add.
But since it's
Same thing for long.
Yeah.
Yeah, I will take a small position. If it's moving in the right
Scale up.
direction, correct, I'll do that.
But since it's a new high breakout, then you shorted on the resistance.
Yeah,
mainly,
correct.
kind of like that.
Correct.
But then it's
But I'm fine with some noise. It's okay.
because it's a micro position.
Yeah.
Okay.
Correct. Correct. So it goes back to risk management.
Yeah, that's
Correct. Unless I'm heavily short with big positions and it move against me, yeah.
Okay. So Jake, with your experience from technical analysis to quantitative analysis,
Yep.
What would be your advice for retail traders trying to level up their game on their own investment? Like, what would your main advice be?
Well, my main advice to most of my clients or my friends out there would be, first of all, to understand yourself. Do you have the right psychological makeup to be a trader? If you don't, then you better not try to. But if you choose to, you better educate yourself. Put yourself through some good causes or some kind of mentorship program, or get yourself through some academy. Learn from someone, right? Get the right mentor to guide you, rather than to jump into market straight. Because trading could be very detrimental to your portfolio or your wealth as well. If let's say you can identify that you are more suitable to be an investor, then start building an investment portfolio. Start with something simple, like for example the index ETFs, right? Build a portfolio out of it, and well, what you can do, maybe you can do a call and satellite portfolio, have a base, have a strategic portfolio, and you add on tactical portfolios whenever you deem fit. Yeah.
Would you say that a big part of investing is the emotional side?
Definitely yes. Correct.
But by having quantitative models, how does
it helps?
Yeah.
Correct. Quantitative models helps you by being more systematically applying your investment methodology, and of course you cannot from time to time override your model. Yeah. You should follow your model.
If you're really disciplined.
Yes, correct.
Okay.
And I can tell you, by being disciplined will yield you the right results. If you throw up your model out every few months, it's not going to help anyone.
Oh, okay. So in your experience, have you ever overridden your model or something?
Not that I know of.
Oh, so you just follow the framework.
Correct. So once I have model, I just follow it with discipline, with with consistency, with discipline. And I just have to switch off my emotional side.
So it neutralizes the emotional problems.
Correct. And of course, it does affect me from time to time. If I'm affected, it's better that you step away, you go for a run, you get yourself distracted because you need to go back and follow a model.
Take time away from the screens.
Yes,
Try
right.
to refresh your mind.
Correct. Yeah, don't let the short-term results affect your long-term model.
All right. So tell us, Jake, on the upcoming Investagrams Trader Summit on July 27, what would be your topic all about?
On that day, I'll be sharing with fellow investors or traders how I build a quantitative investment model.
So everything that we've discussed today, from using fundamental metrics, combining it with quantitative factors, technical parameters, Jake will be discussing on the upcoming Investagrams Trader Summit this July 27. So Jake, thank you so much for the wonderful interview.
Thank you, JC. Hope to see you there.
All right.
Thank you.